hello, Mavericks. It's nice to see you here. This is Rob Reinhold. I'm joined by Mr. Darren Fisher, and let's cut the chit-chat and let's just get into this week. This week was ugly, ugly, ugly. Our call last week was that the market was going to be choppy, and the words I said was, this market was out to screw everyone, meaning that every rally fell apart and every sell-off was bought. That absolutely happened Monday, Tuesday, and Wednesday. Now, I also said I could see this action lasting for another couple weeks. Thursday proved me wrong. Thursday was a very strong move, and then we got a huge follow-through on Friday. So we were basically flat on Wednesday, and by the end of the week, we were down 4.5%. Now, that just came on 2 days. Now, we are back to the May lows. We'll take a look at the charts, but we are quickly, within 2 days, back. We lost everything we've put in on this little bottom. We lost it all in 2 days. Very, very negative. The culprit of all this was inflation / interest rates. So we got the CPI report. It was at 1%. Expected was 0.7%. But the biggest thing was the year over year, plus 8.6%, the highest inflation since 1981. It's a problem. And for any of you that were alive in 81, you remember it. I was alive in 81, but I was 7, so I definitely don't remember it. But I do know what happened was that Paul Volcker, the chairman of the central bank, he aggressively raised rates. And I remember my dad telling me that interest rates were at 18% if he wanted to get a loan from the bank. But he also said he took the loan because his business was growing so fast that it didn't matter. We're not quite in that same place where the economy is growing so fast that these higher interest rates don't matter. Darren, what do you think about this inflation report?
You and I have been beating this drum for 2 years, and I think that we're to the point where inflation is going to keep increasing. I think it's going to hit. It's going to peak over 10%. I think it actually is once you count on. If you counted food, if you counted energy, if you count rents, I think we're actually well above 10% right now. So this number, I think, does not fully include everything that's out there. So I think we see a lot more out there. The one that got me as well was the consumer confidence, and it's understandable. I mean, when you're paying $5 plus for a gallon of gas, you've got to fill up once a week, and it's costing you, $80 to fill up. I mean, I've got a V8 in one of my vehicles, and that's over $100 to fill up that. You begin naturally cutting back on other things. The price of meat up probably 40% from 2 years ago, at least locally for you and me. The cost of propane is over 10% up from what it was just last year. So that inflation number to me is not totally reflective of the actual situation. And I think we're just beginning to start to see demand destruction from all this right now. So I think it gets worse before it gets better.
Geez, Darren, I'm not inviting you to any of my parties anymore. That was bleak. Very bleak. But
yeah, I'd be a little bit of a doubter on that one.
Yeah. But I think you're talking some sense. I think it's very likely to happen. So let's jump into the charts. Nasty, nasty week. Dow down 4.5%, S&P down 6.2%, the Qs down 6%, Russell down 4.5%. Cryptos were killed. Pretty much every risk on asset was crushed. So let's take a look at where we are in the charts. So let's go back to our bottom here. We had our double bottom here. We talked about the double bottom. We talked about this point being the neckline. This is the neckline of a double bottom. And basically, what it says is once that point is broken right here, then you can say, oh, that was a good bottom. That was a good bottom and should be durable. The problem is someone forgot to tell this market, and there was really no big buying pressure. And you can see we hung out above the neckline for about 2 weeks. And every time I got up to the top and looked like it was going to break out, it fell. Every time I got to the bottom, Thought it was going to bounce. It did. So you can see that up until Wednesday, everything looked fine. But Thursday opened up and plunged, and there was relentless selling, and it closed on its lows. We got a gap down, relentless selling, closing on the lows. So here we are now back down to the bottom. Now the thing about support and resistance, the more it gets tested, the more likely it is to be broken. The fact that we are back down here and we broke that neckline really tells us, okay, that double bottom was definitely not a trend-changing pivot low. It's not. The only question I have here is, do we have a bounce off of this support short term and then we plunge below it? Or do we just plunge below it without a bounce? I think we're likely to get the second, just a plunge below without a bounce. What do you think, Darren?
Going back to our last week's theory of this market is out there to shaft absolutely everyone. I think we open at today's close on Monday, and we rise for the first half of the day, and then it reverses. I think that's pretty wild speculation for what's going to happen 3 days from now. But I think this market still has some more potential to just shaft absolutely everybody.
Okay, so it's just the same as me. We don't know exactly how we're going to get there, but we both agree on where we're going, and that is lower here.
Yeah, and where I'm grappling with, and the reason I'm extrapolating this out is I'm looking for good entry points right here. I mean, obviously, what we both want to be short the market. Is just where's that entry point? And in the market volatility like this, it's very hard to find those entry points. I mean, you could have made the argument for that everything was confirmed once we broke below the 20-period moving average yesterday. That would have been a decent entry point, but it was such a short amount of time that you had to enter. It's to me, it's very difficult to get the conviction to make an entry like that, and I think that's where a lot of people are going to be. I mean, if we gap lower on Monday, that would be an obvious entry point as well. But it's also a recognized buying point. It's just such an inflection right here. Difficult to know when to pull the trigger. I think that's where a lot of people are going to be looking at on Monday.
And surprisingly, in the Qs are actually doing better. And I have not been able to say that for 5 or 6 months. That, in this bounce, tech did better. But outside of that bounce, we've seen the Qs lead it to the downside and the S&P follow. Now we're seeing actually more weakness in the S&P than we are in the Qs. It doesn't matter at all because it still looks like trash. This still looks like garbage. So just the fact that it's slightly better garbage doesn't make it not garbage. Question is, do we just go below it and not have a bounce, or do we have some sort of bounce or base in this area? Again, my call is we go down. I think you're right. We could have these little half-day bounces. But I think Monday and Tuesday are going to be pretty severe down days. Going into the Fed, where people are really, concerned about how aggressive the Fed is going to be. And I think there's no reason at all for anyone to step in and buy until they hear what the Fed has to say on Wednesday. So I just think there's going to be a buyer strike on Monday and Tuesday. And I think there's going to be a lot of sellers out there. And because of the imbalance, the market is likely to fall on Monday, Tuesday. And we got the VIX here, not at high levels. So anyone here looking for, there's a big panic, a lot of people have gone out and bought hedges, that is not true. That is absolutely not true. We've got a lot of room to go back up to this 34 area. Everything to me looks bearish. Everything's bearish. So we're going from our 0 to our -2. Now, before we go on to look at the sectors and look at some trades, I want to talk about, just as a trader, we always have our outlooks. Now, my outlook last week was volatile, choppy trading for the next couple weeks. And the first 3 days, I was right. That's what we got. And I built my positions. On a 0 outlook on the market, meaning that I had some longs here, some shorts here, some sideways stuff here. I was basically delta neutral on my portfolio. I was wrong Thursday and Friday. And right now, my portfolio on Thursday was not weighted correctly to what the market was doing. I was at a 0, and when the market went to a -2, I spent a little bit of time getting a little bit more short on Friday, taking some more bearish positions, but I'm still not where I should be at a -2. So this week, I need to be able to go in and move into -2. But the reason I'm telling you this is that we make calls all the time as traders. You do, I do. Every single time we click a button, we're making a call. When I was a young trader over 25 years ago, I was so convinced that I was right. I thought I was so smart all the time because I could make a good case for it. After getting your butt kicked a couple times, maybe even 10, 20 times, you start to get humbled by the market. So I will throw away whatever I had as a premise when new data presents itself. That's something really difficult for young traders to do because they think, oh, that support is here, resistance here. This is how it works. This is what I read in books. Guess what? It doesn't matter. Things change all the time. You've got to be flexible as a trader. So now I've got to get to a -2 in my portfolio. That's just what I have to do, whether I feel like it or not, whether I think the market's going to go lower or not. I might think that we might bounce next week, but guess what? I can't play that because that's not trading the market in front of you. And that's our saying in Maverick, trade the market in front of you, not the market you want it to be or think it should be, the market that is. And this is a -2 market, period. So next week, we've got Fed meeting on Wednesday. So for me, I'm looking at this. If selling is intense Monday and Tuesday, I actually think the Fed meeting could be the relief and it could bring a rally. So the harder we go down at the first of the week, I think the bigger we could potentially bounce after the FOMC meeting. If we actually go up into the FOMC meeting, I think the FOMC meeting could be the thing that pushes us down. So I do think Wednesday could absolutely be a reversal short term in whatever direction the market's going. So Wednesday, 2 p.m. Eastern time, the market is expecting a 0.5% interest rate hike. And the market was expecting an interest rate of 2.5% by the Fed by the end of the year, before Friday's CPI report. Friday's CPI report basically moved that up to 3%. So 50 more basis points just got factored into interest rates through the end of the year. And that's why the last 2 days we got hammered, because everyone was looking at it saying, okay, let's build our models around 2.5% interest rates by the end of the year. So they built their models. All of a sudden now their models say, oh, it's going to be 3%. Well, we're too long. We're too long. We're too aggressive. We need to pare that back because data changed. I even heard a couple banks come out today and said that there was a possibility for a 0.75% interest rate hike. So all of a sudden, now people are having to change. Remember, the way the markets work is the price today, it reflects what people think the situation and prices are going to be tomorrow. So if everyone was thinking 50 basis points on Wednesday, they price that into their actions that day and where the market was. If all of a sudden that changes to 0.75, they have to reprice. They have to adjust. So going into this meeting, I think there's a group of people out there that think it's going to be 0.75. And there's a group of people out there that think it's going to be 0.50. When you get that, what means is whatever happens, whatever the Fed does, one group has to reprice. One group has to be like, oh, we weren't aggressive enough. We need to now get more long. Or we were too aggressive. We need to get net short. Whenever there is uncertainty on what the result is going to be, it causes more volatility. And that's really why I think there could be, the Fed bringing a market rally if we have, 2 really strong down days. But other than that, I don't see this being anything other than temporary. I think the long-term picture still looks bad. Anything to add on that, Darren?
No, I mean, you and I were talking beforehand about what the Fed, is going to do versus what we think they need to do. on a kind of a personal note here, to see real leadership from the Fed, I think they would have to come out with a 100 basis point. Yeah, I priced that at less than a 10% chance that that's going to happen. But, just personal musing at this point.
And I think if they did that, I think there would be that initial panic, that initial reaction down. But I think it would give people some relief. I actually think the more aggressive the Fed is, the better it will be for the market. I know that sounds crazy, but I think if they do 75 basis points, I think we do get that spike down. People say, oh, we didn't expect it. But then people say, oh, wait, the Fed is serious about this. Maybe we are at the tail end of the inflation story. As far as economic reports go, look on the list and then pretty much forget everything. It's all about the Fed here this week. So let's take a look at some sectors.
Yeah, so you can see the sector performance. There was not anything that looked good at all. I mean, the worst one was financials, down 6.7%. Tech and real estate were very close behind. Energy was the best one, and that was less than a 1% drop. Everything else, you're in the 4 and 5% category right there. So everything lost a lot of traction this week. I mean, it just turned absolutely ugly. So let's take a look at them individually on the charts. So here's utilities, and you can see we broke down, pretty good. Now I'm going to go with a +1 on utilities, and here's a reason why. I know this deviates. I mean, this is going to be technically a +2. That's pretty close to a doji on Friday. Thursday was pretty ugly, but Friday's candle, looked like there was sellers initially, and we hit that previous support right there, and we held it. And then it looked like they wanted to come back. So I'm knowingly deviating from my criteria just for the market action on Friday. So I'm at a +1 on utilities right there. And communication services, last week it was a 0. I mean, this just went right back down to a -2. We're back down there at support, and you can see it's just been nothing but ugliness right there. And it's, again, not looking good. I mean, this has not looked good for 6 months, and it continues to be one of the ones that leads the pack lower. Real estate, we're going to see a lot of stuff here, and we'll recap it at the end. A lot of stuff is just going to the -2. We were to 0 last week, and we're at a -2 right here. You can see we broke below lows on real estate. So we're clearly below the May lows, and it looks like it's nothing but down from there. So industrials, this is, again, another one, -2. I mean, solid, decisive action. We're not quite there to lows, but we're pretty close to them, so this is looking good. I'm going to sound like a broken record here because healthcare is the next one up. Looks exactly the same. We're down there. I mean, this is even a little bit weaker. Broke below the lows, closed below those lows, and it's just not looking good. This was healthcare was I had a -1 last week, and this one clearly, I mean, you could see in a period of 2 weeks to go from almost regaining that 50-period moving average to right back down, breaking below the lows. There is no, well, what do you want to call it? There is no sticky money in this market, in this sector at all. There are a lot of weak hands out there that are just looking to get rid of a lot of stuff. Financials, I mean, same thing. You can see it, again, broke below the lows. This just wants to, one of the things that wants to lead everything lower, and it's doing a very good job of it as well. So this is one that I'm going to be looking for a lot more shorts after Wednesday. I want to see what the market action happens on Wednesday, and then I'll be looking at financials to see which way I want to go. Consumer, looking a little bit better here, which kind of actually surprised me. I'm only at a -1 on consumer. If we get I'm between a -1 and a -2. If we get another down week, I mean, this is clearly going to be a -2. But you can see it held up better than a lot of other things did. But it's an ugly market for a lot of things. Looking at tech, back down to the -2. We're at the lows again. Now, for all these things that are back at, if you've broken below the lows, I think you keep going down. For the stuff that is at or has not quite hit their lows, there is that possibility of a bounce. But I think, I think they might bounce for a couple of days and then break lower. I mean, the market direction is clearly to the downside right here. Materials. This is one that really surprised me. Look at that. 3 days ago, we were at a pretty good place as far as materials goes. Last week, I think I was at a +1. In a period of 3 days, we gave everything back and we're approaching the lows again. I mean, that's just a massive, a massive drop right there, nearly a 10% drop in 3 days. So I mean, you can see, this is looking to the downside. So I'm actually, for the first time in a long time, at a -2 on materials. And finally, energy. And energy, if you're long, has been the gift that keeps on giving. You can see we just had a very, very minor pullback. We're still not to the fit 20-day moving average right there. And so this is looking good. We could get a little more to the downside, but technically you have to like energy. Energy is one of the places that we want to be long. We have been long. It has been rewarding to be long. Keep bringing that register until it doesn't work anymore. And so, anyone who wants to short energy right now, I think it's they're in a hurting position. So you can see we've got 1, 2, 3, 4, 5, 6, 7 sectors at a -2, and we've got one at a -1. And then the only things that look semi-decent, energy and utilities. So if you want to be long, so everything else is looking to be pretty short out there. And now, again, let's caveat this. This is extreme ratings. Now, anytime you get to the extremes, to have 7 sectors that are this bearish, anytime you get to those extremes, there is a possibility that you revert to the mean. So there's a possibility of a rally. I don't think it happens. I think it showed in the VIX. People are more complacent, even with Thursday and Friday's action. There's a lot of complacency in the market compared to where we were at the previous lows. So I think we actually have room to go down there. So let's look at some potential trades that are going to show up for us this week. Now, last week we didn't do utilities. We did real estate. We had STOR short. That was down -3%, which compared to what the markets did, that actually outperformed, but still looking good to the short side as well. This week we're going to go back to utilities. And what we're looking at is energy resources. We played this a couple of times. We're going to play this, for a bull pullback. It could go all the way back down to, that 43 area right there, 43.50 right here, and wait for confirmation. By confirmation, I mean a higher high and a higher low from the previous day. That lets you know that the selling is done and the buyers have come back in. But this has been very strong, and I know you can take a look at how strong it's been. If we get that bounce in the utility sector, I think this is one of the ones that leads it. So just wait for that confirmation, and then a couple of things that you could do. I'm probably going to be looking at going out to July along the 40s, and then short next week's 45s against it. A little diagonal spread right there. If you don't want to be that aggressive, just a straight 40-45. So communication services last week, we were short Twilio, and that was a good place to be because Twilio was down 10.8%, looking pretty good on that one. This week we are going to be looking at Meta, there's Facebook, and this is a bear rally, low base, whatever you want to call it. It looks pretty ugly. You can see it broke below 180 right there, which has been had been support for a good 3 months, and we just continue to keep going down right there. So this is a good place to be short. Right now it's at 175. So what we're looking at here, I am actually going to go out on a limb and go long those July 185 puts. Don't go long unhedged calls or puts very often, but in something like this, it's going to be looking pretty good. You can size them for max loss if you want, or if I'm wrong on 30%, I'll just exit the position. If you don't want to be that aggressive, go out 2 weeks and do the 170, 180 bear call spread. So last week in healthcare, we were long Pfizer, PFE. This one didn't do too well for us. It was down 6%. So if you have more time in the trade, you can stay in it, or if you want to cut your losses, just go ahead and cut your losses. This way, what we're looking for is GlaxoSmithKline, GSK, and what we're looking at is pegged right between the 43 and 44 right there. We're going to play this sideways, so how do you want to play it? You could pick a butterfly if you wanted to, but we don't do this often, but this is a perfect place for a condor. So I'm going to be looking next week's 41, 43, 44, 46 condor right there. So as long as it stays between 43 and 44, I think that we're going to be pretty good.
Last week in industrials, we made a call on Southwest Airlines sideways. Looked pretty smart for the first couple of days, and then Southwest Airlines, along with everything else, came apart, down 8.4%. I know that I've got one more week left on this trade, but it is definitely not looking like it's going to come in. So, sideways is tough here. When market volatility picks up, it's really tough on these sideways trades because the volatility tends to move everything. And remember, it's really a play on, I don't think this is going to move much. When market volatility spikes, it's almost impossible to make money on these butterflies, especially if they're short term. If they're longer term, you can let them come back and wait a little bit. But when you're shorter term, it definitely throws some wrenches in. It definitely throws a wrench in your plans. This week, 3M. Now, 3M has been making a low base here all the way from February. So February, we got down to 140. And you can see every time it got up above 150, it didn't stay there for very long. And we now have cracked. Now remember, when something bases for this long, you usually get an expansion of energy for about the same amount of time it based. There could easily be a down move in 3M for the next 2 to 3 months. Now look, I don't play these that long term. I'm a shorter term trader. So I'm looking for something really short term here. This week, 135, 140. Now look, this is not a very courageous trade. This is a pretty simple trade. This is going to get net in about $2.80. So 280 is going to be my upside. 220 is going to be my risk. I'm going to position size this for max loss. And on Friday, I'm going to either make 280 or lose 220 or somewhere in between. This is not a really risky trade. This is a very controlled trade. And I've already predetermined that there is not going to be any early exit. I'm just going to get what I get on Friday. Now, the reason I do that is that human beings are terrible at deciding exits. All the studies show that human beings are really good on entries and they're really terrible on exits. So we love to do this because it just takes the exit out of the equation. You don't even have to think about it. You just put it out there and you get what you get. So if it does close between 135 and 140, you will have to close off your short leg. But other than that, you're either going to get your max gain or your max loss. In financials, this is my favorite sector to the downside. Financials look terrible. And so last week we actually had a long in financials. We had a Unum, UNM is a ticker symbol. Long, it's an insurance company. It looked good until Thursday, Friday. It was actually up nicely during the week, and then Thursday, Friday hit it down 3%. I still like that one. I know I've got that one on a diagonal, so I'm definitely able to sit and wait for that one. This week, we are looking at Berkshire Hathaway. Now, these are the B shares. We are going to be looking for a short here. Now, I was looking at these, and I was like, okay, how do I want to play this? I wanted to play this longer term. So I actually originally looked at going all the way out to July 15th, saying, okay, I want to be short. But it was just too... it was just too appealing to not get this week's options premium. Now, what I mean by that, like I was going to look out to do like the July 15th, like 300, 280. I could do a bear put spread or I could do a bear call spread. It doesn't matter. So I was looking to go all the way out, say, hey, let me give this some time. Let me give a big window here, a 20-point window. But then I said, no, I want to pick up this week's premium. So I'm going to be doing this trade, the July 15th 300 put, sell this week's June 17th 290 put. And at the end of the week, I have to make a decision what I want to do. I can close the whole trade. If it just goes sideways or bounces a little bit, I can probably close the trade off at a small gain or a break even. If it really tanks this week, I'll make some money, just not a lot of money. But what I really want to do is hope that it stays right around 290. And then at the end of next week, I'll then go sell the July 280 put and turn this into a vertical spread. So I just want to get this little bit of capital, this little bit of premium here before I go to the real position I wanted to take.
Yeah, consumer. Last week we were short Wayfair. Symbol for that is W. And we were rewarded nicely on that one. Wayfair was down 11.6%. So that was a good trade to keep in the portfolio. This time we're looking at Philip Morris. Symbol's PM. We're going to do that sideways. And the way we're going to trade that, we're going to do the 100. Actually, it's going to be the 95, 100, 105 butterfly. Puts or calls doesn't really matter. The risk graph is absolutely the same. So, just look at a butterfly on that one with a 100. This is going to go 2 weeks out here. We think that this is going to be sideways for the next 2 weeks, and size this for max loss and let it run for expiration, because if we do get the volatility, you're going to be profitable one day and at a loss the next, and so just size it for max loss and let it run. In technology, last week technology, we were short Fastly, symbols FSLY, excuse me. And that was down 7.3%, so that looks pretty good right there. And I know a lot of people are in that trade. This time, we're looking at Coinbase. This is a low base. You can see we have been basing for the past 2 weeks, and it really can't get out of its way. Look at the scaling on this. That's $20 scaling. So this is going to move very, very quickly and very, very wide. So taking a look at how far down it's come. I'm going to go out there and I'm looking at the July 65 puts. This one is going to go to the downside. This is going to be expensive because it does move so quickly. But you take a look at the entire crypto sector, and it just keeps getting beaten down. You and I were talking, Rob, before, and you and I were talking before, Rob, and we were talking about where does Bitcoin go to. And I think you and I both said 10,000 is not an unreasonable target for Bitcoin to get down to. And you have to remember, not too long ago, Bitcoin was at 60,000. So anything having to do with cryptos right now, they were just an inflated risk-on asset. They're getting absolutely crushed right now.
Darren, I really like this trade, and we just met with our currencies division, and pretty much every single one of our currencies traders, there's no bottom right now. And there just is no bottom. There's no credible bottom. No one, there's no line you could draw on a chart. There's no anything. And just to put this in perspective, that Bitcoin was at 9,600 before the pandemic started. So if we're going to go back down to where we started during the pandemic, Bitcoin and Ethereum, they've got a lot of room to go down. And, stocks are going to have some level where they're so cheap that, they can always go down more, but they tend to not go down when they get to very, very depressed levels of price earnings ratios. Cryptos don't have that. Cryptos is 100% what is the feeling of people out there. It's fiat money. And that's what happens when fiat money, the value of fiat money is determined by the masses. In materials, last week, we were long MT, which is a steel company, and it was down with the rest of the market, but only down 3%. So again, we saw that materials lost 6 or 7%, MT down. Look, it's one of these trades that I don't like the outlook. I know that we had some traders take that off for a loss. This is just one of those, I think it's just best to take off for a loss and just move on. Down 3%, not that big of a deal. It's very small. Just move on to the next one. And speaking of the next one, we got Alcoa. And the aluminum manufacturers just look really terrible right now. And we had this big fall. We had a rally. You can see we just held there for a good 3 weeks. And then Thursday, Friday. Now we are trading below these levels. And you can see that these are very critical levels, this 55. And if you had access to the chart past this, if you want to just pull it up on your system, you'll see that 55 has been support for a while here. At 53, I like this one to the short side. Now I'm going to play this very short term because I'm looking at this saying, boy, this is a lot of velocity now. But at some point, there's going to be a bounce in this stock and in this sector. So I'm just looking to go out 1 week, and the 50-55 is what I'm looking at. Now at this price, I'm probably going to get in about $3.10. That means my risk is going to be $1.90. If that's the case, again, I'm going to do the same thing I did with the other one. I'm not going to try to time this exit perfectly. I'm not going to try to do everything because that's going to be very difficult. I'm just going to make the play that this is below 50 by the end of the week. That's my bet. It's below 50 by the end of the week. If I win the bet, I win $3.10. If it goes up, I lose $1.90. If it only goes down a little bit, I'll make 40, 50, 60 cents, whatever. But that's the bet, is that it's going to be below 50 by the end of this week. And last week in energy, we had Antero Resources, ticker symbol AR, as a long, and it was up very, very nicely the first part of the week. And by the end of the week, it had only closed up 0.3%. So it's one of those where it's still a winner, but it's just not all that great. Let's go into this week. So for me, I'm looking at the market, and energy looks awesome. It looks fantastic. But I'm not dumb, and I know that this market is in some serious trouble. And finding longs was very difficult this week. Now again, at Maverick, we believe in a balanced portfolio of trading positions. We are basket traders, and so you can't be 100% short because bounces kill you. So you've got to have a blend of things. And so energy is definitely a sector I want to be long. The problem is I'm a little bit worried about the risk. Whenever that happens, I go down the beta scale. Now, beta is a measure of how much risk a stock has. So Antero Resources that we traded last week has a very high beta. It's a very volatile stock. It's a crazy stock. It's gone up 150% over the last 6 months. All I'm saying is this week, if I'm going to play a long stock, I want to play the most boring oil stock. And this is our favorite here at Maverick, Schlumberger. All right, quick story. You're going to have to hear this every single time we talk about the stock. The stock is called Schlumberger, but about 20 years ago, I was trading with Joe, and I'm asking what he's trading. He's like, I don't know, I'm in this stock called Schlumberger. I fell off my chair laughing. I thought it was the funniest thing because that's literally how it's spelled. And I remember looking it up thinking, oh, it must be a French company. No, it's an American company. So we at Maverick now call it Schlumberger. You can't call it anything else. You get kicked out. We'll kick you out if you call it Schlumberger. It's Schlumberger. All right, well, let's talk about the trade. We've got this pullback. We do think that energy is likely to pull back with the rest of the market. There's no question that energy probably has a little bit of downside from here. Somewhere in this 20-period moving average, we've got some support. Somewhere in this range here, we do expect there to be a bounce. And I purposely chose this one, not because of its chart pattern specifically. I chose this one because it's low volatility. Low volatility. So as you can see here, if let's say something crazy happens, the market goes down another 5%, this stock probably loses $1 or $2. Where something like the Antero Resources will get killed. It'll go down 10%, maybe even 15%. So I'm purposely going down the risk curve to trade a very, very boring, stable, safe stock. So the only question is, how do I want to play it? I love to play these kind of stocks in diagonal spreads, but I have to wait for a confirmation. If this bounce happens quickly, I can do this diagonal trade. This is the one I want to do. If it takes 4 days to bottom out and I finally get my signal on Thursday, I can't do this one. I'm going to have to go out to the June 24th. But that's the trade I'm looking to make on Schlumberger off of a bull pullback. So to wrap this up, we're retesting lows. The more times you retest lows, the greater the likelihood is you're going to break through it. That's just how support and resistance works. Volatility is likely to increase as people freak out and as levels get pierced and stop orders get hit and funds get liquidated. you're just going to see more volatility. In volatility, it's very important to have strict position sizes. Don't put your capital out there at any time to where it can give you a 25 to 50% drawdown. Like, just don't do that. It's up to you. Have total control of your position sizing. You have no control of what your positions do, but you have total control of your position sizes. So take smaller positions and take more positions. It's going to be the best thing to do in this environment. This week, we're going to be meeting 3 times live. So on Tuesday, we're going to do a live trading lab, and that's going to be an option strategy. We haven't decided yet. Wednesday, as usual, Joe's going to do his midweek update. And then on Thursday, I'm going to do a session on summer trading. I've been doing a lot of data mining, and I've got some cool stats for you. And, well, I'll give you a little spoiler alert. Actually, yeah, I'll give you a spoiler. I was going to keep you in suspense. The spoiler alert is that summer trading isn't as big of a deal as it used to be. It used to be very low volume, very low volatility, and really over the last 20 years, that has changed to where there's now very little difference in the summer months. So we'll talk about that. Oh my gosh, I literally just spoiled the whole thing. Well, Darren, should we just cancel the session then? I just blew it.
Yeah, that was the class, Rob. Good job.
That totally was the class. Now people are like, I don't need to show up. Dang it. I put a lot of work into this one. All right. Well, everyone have a great weekend. Stay safe, and let's go get them next week. We got a nice trending market again. I love trending markets. Up markets, down markets, I don't care. I just want them to be trending, and that's what I'm getting. Have a good weekend, everyone. Goodbye.
Good trading, everyone.